get started because those that turn up a few minutes late, we are recording today, so no doubt they'll be able to watch later. But welcome everyone to our Global Minimum Tax and Impact on Transfer Pricing webinar. We want to go through some of the insights that have actually been happening around this area. I know it's very topical at the moment. Today, obviously, is going to be general information, so please don't grab what you hear and say, I heard it from Transfer Pricing Solutions and now I'm going to implement it. It may not be specific to your situation, and I know many of you who have worked with us in the past will know in transfer pricing, it always depends on the facts and circumstances. So this is all general information today, but hopefully it's going to give you some insight as to what's going on the global minimum tax as well. And of course, you can obviously reach out if you need any assistance from us. So for those of you who haven't worked with transfer pricing solutions before, just to give you a little bit of a background about our business and our firm, the Transfer Pricing Solutions, we do specialise in providing practical and proactive and cost-effective transfer pricing from our experienced team to our global clients. And that's really a focus, and I think a lot of those that have worked with us for years will actually say that our practical approach to transfer pricing is something that they all really appreciate in working with us. So a bit about our entity. So we actually started in Australia nearly 18 years ago. In Australia, we expanded out into Singapore. So we've got our office in Singapore and also the office more in the last 5 years in Malaysia. And in the past 18 months, we felt we needed to increase our footprint and a lot of demand coming from United Arab Emirates. So we're now actually in four locations around the world. We do actually assist clients on a Asia Pacific, but also global transfer pricing base, but these are our footprints throughout the world. We have been recognised not only in Australia, Singapore and Malaysia, but also on a global level for our expertise in transfer pricing, whether that be awards. Also, we were recognised as Tier 2 transfer pricing advisors in both Australia and Singapore, ahead of other very well-respected transfer pricing advisors as well. And so we do have that recognition behind us. For those that haven't met me, I think I've met probably half the people on the webinar today. And for those that haven't met me, my name's Shannon Smith. I'm the founding director of Transfer Pricing Solutions. Started nearly 18 years ago in Melbourne, Australia. I've been advising with clients now for a very long time. I worked with one of the big four in Melbourne, went on to work in the Czech Republic, Amsterdam, and then New York City. I have a background in accounting and taxation, which when it comes to transfer pricing, having those two areas as well. So, and then came back here to Australia, obviously. And Adriana started with Transfer Pricing Solutions back in 2007, I think it was, in Australia. And then she's been actually now in Singapore. I think we're heading on 9 years now in Singapore, heading up our Singapore operations. So Adriana is the co-founder of Transfer Pricing Solutions in Asia and also in Malaysia. She has a lot of experience in assisting clients in transfer pricing and has a law degree background and has been advising clients on many areas of financial transactions and restructuring projects throughout Asia and actually throughout the globe as well. Adriana also teaches at the Singapore Chartered Accountants and the universities over there as well. And Hong Tran Tan, so HC actually HC has a dual role actually, based in Australia, originally from Malaysia, based in Australia, and I think he's got the ideal job, actually living the dream. He gets to spend half his time in Australia and half his time in Malaysia. So he works on both sides there and has been with actually Transfer Pricing Solutions now nearly 7 years. I think he's counting it down because he gets long service leave soon, you see. So he's keeping those years going. But HC's been very involved in also a lot of speaking on webinars, seminars, and workshop on transfer pricing. And he loves that education side of the transfer pricing as well. So what are we going to go through today? It is going to be an exciting agenda. Well, nearly 200 people thought it was going to be an exciting agenda because you've all signed up to come in today. But we're going to talk today about an overview of BEPS 2.0. What does that all mean? What does it mean on the application of Pillar 2? And what, as we always like to do, we're going to give you a practical case study. None of this just giving you all the theory and try and let you work it out. We want to give you a practical case study on how you can bring that all together as well. So I'm going to hand over to Adriana, and she is going to take us through an overview of BEPS 2.0.
Thank you, Shannon. So today is a very special webinar for us. We were thinking when was the last time that we did a webinar all together. So it is great to be here talking about a very important topic, which is basically BEPS 2.0. So we always try to make sure that we can explain where does the global minimum tax sits within the BEPS initiatives. So it is important to understand that the BEPS initiatives started first with BEPS version 1, which was around transfer pricing documentation and tax. And now we have BEPS version 2, which is basically two key pillars. Pillar number 1, which is the special purpose nexus rule to reallocate taxing rights, is basically kind of a redefinition of the standard taxing rules associated with PE and physical presence. And then we have pillar 2, which is where global minimum tax of 15% sits. So it's good to understand and get a little bit of an update of what pillar 1 is at, because we always see in every newsletter or newspapers minimum tax 15%, 15%, but pillar 1 sometimes is a bit of an underdog that is forgotten, nevertheless is still evolving. So we have two components of pillar 1. One is Amount A that introduces a new taxing rights aimed at digital companies regardless of physical presence in the country, where basically their taxing rights are linked to users or customers. So Amount A, even though it was number A, it was a bit left out. And the one that is evolving more is Amount B, which is basically a standardized return for certain baseline marketing and distribution activities. So what is the purpose of Amount B? In theory, is to make it easier for marketing and distribution activities to know what is the expected operating margin return that a taxpayer should earn for those activities. Now, the reason it has become more popular than Amount A is because Amount B has now a final report from the OECD for implementation in the local countries. Now, for anyone who has read Amount B, it is not that straightforward. And I think in hindsight, it deserves a separate webinar, just an idea here from our side, because even though the idea is to simplify the operating margin for marketing and distribution activities, the application of it requires certain calculations that are a bit difficult. So this is just to say that even though the focus of this webinar is about global minimum tax, keep an eye, if you are a tax enthusiastic like we are, keep an eye on Amount A and Amount B, because it is still evolving. And Amount B, just like to give you some insight here, Amount B is one of the rules that even Singapore is thinking on start implementing from 2025. So just keep an eye on it. But coming back to the main topic of our webinar today, which is about Pillar 2 and GLOBE rules. And we always try to challenge ourselves and see, okay, are we going to be taken or overtaken by ChatGPT or not? And then we ask ChatGPT, what is global minimum tax? And according to ChatGPT, global minimum tax is an idea proposed and endorsed by multiple countries to ensure that multinational corporations pay a certain minimum amount of tax regardless of where they are headquartered and where they are allocated their profits. So it sounds very easy. Oh, okay, just basically minimum tax to be paid in a particular country. But what ChatGPT actually misses is the how. And I think the how is what it is difficult. And that's where ChatGPT will never overtake tax advisors. That's my personal opinion. So let's just go and talk about really in detail what are the GLOBE rules and what are the steps to be taken into consideration to understand whether it applies to you who is attending this webinar. Okay, so to make it somewhat simpler, given that we only have an hour today, we have divided the the 5 steps that are relevant when it comes to understanding the application of the GLOBE rules. And I'm going to be going through each of these 5 steps. And following that, Honchon is going to come in and talk to us about other very relevant aspects of GLOBE to take into consideration. So step 1 is identifying the multinational company that is within the scope of GLOBE rules. Step 2 is computing GLOBE income, which is the numerator in the calculation. Step 3 is compute the adjusted corporate tax, which is the denominator in the equation. Step 4 is compute the effective tax rate and top-up tax. And step 5, which is a very important one, is, okay, now that I know that I have to pay top-up tax, who do I pay to? Or more relevant, where do I pay to? So that's the payment of the top-up tax. Let's start with step 1. So identifying the multinational companies that are within the scope of the GLOBE rules. So for these, the main criteria is the consolidated revenue. So multinational companies that are within the scope of GLOBE rules basically are the ones who have annual revenue on euro greater than 750 million for the last 2 years of the 4 fiscal years prior to the tested period. So my tested period is 4 years. If 2 of them, I have my income being above 750 million on a consolidated basis, then I will have to see how do I comply with the GLOBE rules. Then I have to understand which entities are part of the GLOBE rules. And that's where it comes important to understand what constitute entities are. And constitute entities are is a concept that is very similar to, I will say, I think this concept comes from country by country reporting, where basically it includes all group entities, including permanent establishments that are treated as a separate constitute entity. So rules very similar to country by country reporting. Then we need to understand, okay, so are there any exclusions? And yes, there are some exclusions. So government entities are excluded. International and non-profit organizations and pensions are excluded. Investment companies are excluded, and real estate funds are also excluded. And the second point is, okay, so how do I determine the location of the constitute entity, which is basically determined based on any local tax treatment. So in other words, domestic tax, which is in most places where the management or the key management and creation happens, okay? So it will follow the tax resident rules, more or less. So once I know whether my company is within the scope, then I need to understand how is it that I need to compute for in each entity whether I need to do or pay top-up tax or not. And that's where step 2 comes in, which is first determining my global income, which is going to be the numerator. So the global income is, or the starting point of the global income is essentially the constitute entity's net income or loss that is used for preparing the consolidated financial statements of the ultimate parent company prior the elimination of intragroup items. So this net income or financial accounting net income has to be adjusted, and there are some rules that are very detailed on the adjustments. These are some examples of adjustments that we have are dividends, equity gain and losses, stock-based compensations, international shipping income, because international shipping income is excluded from the GLOBE rules, which for those of you who are in Singapore will know that this is a massive pool of exclusion from Singapore point of view, having so many shipping companies. Or even in any other countries where there are so many shipping companies as well. Then, so this is the numerator. Then we have the denominator, which is basically computing the adjusted corporate tax, which basically is the amount of, is determined by taking the constitute entity current taxes for the fiscal year adjusted to reflect certain timing differences. So once the adjusted of the corporate taxes are performed, I will have my adjusted corporate tax, which is what I will use as a denominator to calculate my effective tax rate and whether I need to do top-up tax or not. So the goal of step 2 and 3 is to essentially define numerator and denominator, and then understand if my actual effective tax rate is above 15 million or below 15 million, because if it's below, then I will have to do a top-up tax. If it's above, then no, because I'm already under global minimum tax. And that's where step 4 comes into place, which is essentially how do I calculate my effective tax rate? I explained it earlier. My effective tax rate equal the adjusted corporate tax divided by globe income, and that will give me the total of my effective tax rate. If this effective tax rate is below 15%, then I will have to calculate the top-up tax, which is basically the difference of 15% minus my actual effective tax rate times excessive profit minus qualified domestic top-up tax. So that will tell me what is my total top-up tax that I will have to pay. There is some de minimis exclusions for jurisdictions where the multinational company has on 3-year weighted average, in 3-year average basis, average globe revenue below 10 million euro and average globe income below 1 million. So if one of the countries, the company qualifies for one of these de minimis exclusion rules, that mean that that company, even though is within a group that is within the globe group, will be excluded from the global minimum tax. Then we have step number 5, which is where things get a bit tricky, which is, okay, so if I have to pay a top-up tax, how or where do I pay the top-up tax? So that's where we have the income inclusion rule and the under tax payment rule that basically governs where does the company has to pay the top-up tax. So the income inclusion rule, what it aims is to allow the ultimate parent company of the multinational group to be the primarily liable entity for paying the top-up tax. And then and that's why probably the majority of the countries have been, and Honchan will talk about this, that the majority of the countries have been very active on the implementation of the income inclusion rule, because what it allows is the mechanism that allow countries to not miss out on collecting the top-up tax on their behalf of the subsidiaries. And then we have the under tax payment rule. That is, if there is a low tax income beneficially owned by an ultimate parent company that is not brought into charge under the income inclusion rule, then the low tax income is subject to the backup mechanism of the UTPR, which is basically if the ultimate parent company is in a place where IIR is not present, then the UTPR rule allows to collect in another jurisdiction. So that's essentially the mechanism on the top-up tax. There is some exclusions from UTPR, which is for the first 5 years for multinational companies with operations in less than 6 jurisdictions and a maximum of 50 million euro in tangible assets. So I think up to here, I have summarized essentially what is GLOBE, how is the calculation, and what's the goal. The goal is to make sure that in each country where the entity or the group has operations, there is a minimum effective tax rate on 15%. And if not, then it will have to be paid somewhere under the IIR or the UTPR. With that, Hon Chuan, please, I'm sure people is eager to hear you and what you have to say about GLOBE, I'm sure. So please come in.
Thanks, Adriana. Um, Thank you for actually providing an overview of GMT. I think that's the objective of this webinar, is to sort of provide awareness of what is GMT, what is an overview of GMT without looking into detail yet, into the calculation of GMT. And when we look at GMT, we'll calculate the top-up tax, effective tax rate. But the next thing that we need to look at, obviously, is to see whether there are any ways to ease the burden on the taxpayers, making sure that, hey, do I really need to do GMT? Do I need to calculate it, right? There is certain safe harbor in place that's being implemented. So there's two. For now, I'll talk about transitional safe harbor. The transitional safe harbor, CBCR safe harbor, is temporary in nature. So it's only available during the transitional phase. Now, what is the transitional phase? What's the period? For now, the transitional period is the period beginning on or before 31st of December 2026, but not including the fiscal year that ends after 30th June 2028, right? So we still have a long way to go, right, until 2028. So that's the transitional period. And I guess the objective of the safe harbor is that it would reduce an MNE's top-up tax for a particular jurisdiction to zero when one of these three criteria are met. Now, the main objective of the safe harbor is to, for the transitional CBCR safe harbor, is to avoid undertaking a detailed GLOBE calculation. So as Adrian has mentioned earlier, there are other complex calculation behind the GLOBE calculation. So instead of using that, the transitional CBCR safe harbor actually uses the qualifying CBCR data and the financial accounting data for CBCR. Now, why CBCR, right? So as you have Adrian has mentioned earlier, the in scope to first identify whether they're in scope or not is if they're above the euro 750 million. So that coincides and mirrors with the CBCR threshold, which is also euro 750 million threshold. But the GLOBE further add on to say that you need to be 750 2 years out of 5 years, which means that gives objectives that the taxpayers will be able to know they are in fact in scope group, so that they can actually start applying or actually do an impact check on GMT now. So this means that these in-scope M&E groups would have readily available data based on their CBC report that they're prepared by the ultimate and parent entity, right? So that's the reason why we have transitional safe harbor in place. Now let's look at three tests. We have the first one is de minimis test. So it involves the jurisdiction that has total CBCR revenue of less than 10 million euro. So we're looking at the jurisdictional level, and the profit or loss before income tax is less than 1 million, right? So if you have constituent entity that falls below this, you can apply for the safe harbor. And then next we have the simplified ETR test. So looking at the simplified ETR test, the very essence of calculating the ETR, effective tax rate, is to use the simplified covered taxes from your CPC report statements. So the covered taxes is income tax expenses minus any taxes that are not covered taxes or taxes relating to uncertain tax positions from the profit and loss before tax, and then divided by the PBT reported in the CPC report. That's how you get the effective tax rate. And then lastly, we have the routine profit test. Now, unfortunately, for the routine profit test, you still need to calculate what we call a substance-based income exclusion, SBIE, using the GLOBE rules, using the GLOBE calculation, and then compare that against with your CBC report profit PBT, right? So if your SBIE is equal or greater than the PBT, then the tested jurisdiction is less likely to have an excess profit for the top-up tax to be applied, right? So I think first thing we need to bear in mind when we look at safe harbor is that it doesn't apply automatically, right? We have a GLOBE information return in place that taxpayers in scope group will need to prepare and actually declare that what safe harbor that you have applied, right? So it's not just, oh, it's done automatically. You actually have to inform in the tax return the GIR to make sure that you have applied any of these three tests. All right, so that's the transitional safe harbor. And the next safe harbor will be similar to the transitional. The only difference is that the tests are applied using the GLOBE rules, and it doesn't use the complex calculation. It actually uses a simplified calculation of income, revenue, and tax calculation through the GLOBE rules, right? So the rules will be provided you how you calculate the simplified calculations in terms of income, revenue, and tax calculation. And apart from that, actually, if you look at it, everything remains the same. You have your de minimis, you have your ETR test, and you have your routine profit test, right? So the permanent one will be after the transitional safe harbor, right? But having said that, if let's say you have looked at your transitional safe harbor and none of that may apply, you can still go to your permanent safe harbor and still apply using the simplified calculations, because some of the calculations may differ from the CBCR calculations, because there are calculations where CBCR does not take into account and GLOBE does. So there may be a difference between a transitional safe harbor versus a permanent safe harbor. All right. Yeah. So after looking at the safe harbor, Adrian has mentioned your IIR and your UTPR. Now we have to look at what we call a qualified domestic minimum top-up tax, right? So this, now I guess we are going to use all these jargons, IIR, UTPR. So QDMTT is a mechanism designed for local jurisdictions where the low tax, below 15% constituting entity is located, to collect tax payment on a domestic level, right? So as you can see later on when we look at the implementation, not every jurisdiction has implemented QDMTT, but jurisdictions can implement QDMTTs to ensure that any additional tax on economic activities within their borders benefits the domestic government, rather than being collected by the foreign jurisdictions where the ultimate parent entity, the UPE, sits. All right, so the QDMTT will first determine the domestic excess profits, and the calculation is very similar to the GLOBE rules, and then you calculate the domestic minimum top-up tax. Now, if you recall step 4, where we will calculate the top-up tax for the group itself, then the top-up tax will then be reduced by this QDMTT, which results in a less top-up tax payable by the UPE, the ultimate parent entity. In relation to QDMTT, one thing that we need to keep in mind is that, hey, we have a QDMTT, then we can apply it on the domestic level, right? But a QDMTT can result in a higher amount of top-up tax than the IIR that I mentioned earlier, when an MME group does not wholly own a low-tax subsidiary entity, right? The reason being is that when you do not wholly own 100%, right, it's proportioned to the percentage of shareholding. Now, for a QDMTT, on the other hand, it must, in principle, impose the entire amount of jurisdictional top-up tax in respect of the domestic law tax entities. So which means 100% of the top-up tax will be then paid to domestic government, right? So irrespective of ownership interest. However, upon implementation, jurisdictions may also decide to apply the QDMTT only to MNE groups, of which the entities are 100% owned by the UPE, right? So that is one of the observation I've observed when we have the QDMTT element in it. All right, I guess let's just recap the pillar 2 GMT. So just to recap, where we have QDMTT, we have IIR, you have UTPR. So these are the top up taxes that can be imposed when the effective tax rate is below the current global minimum tax rate of 15%. It may change, but for now it's 15%. And let's look at the 3 top up rules under the GMT, right? If you look at this graph, there is actually a hierarchy between the rules. So if you look at the formula that Adriana has mentioned earlier, it's first looking at the top-up tax, and then you have an element of the QDMTT. So the first order of priority would be the QDMTT. We need to look at the tested jurisdiction, whether the QDMTT applies, right? So when it applies, that will be the first right for the domestic government to collect that top-up tax. Okay, so when QDMTT is not implemented in the tested jurisdiction, right, then it will fall back to the IIR, the income inclusion rule, where the top-up tax will be paid by the parent entity in the foreign jurisdiction where it's located, right? So there's IIR. Now, when QDMTT and IIR is not available, as Adrian has mentioned, UTPR under tax payment rule is a backstop rule where any jurisdiction within the MMD group has the right to collect the remaining share of the top-up tax by way of going through the expense level, denying of deductions, etc., depending on the UTPR rules that is put in place, right? So this is the order of priority when we look at how top-up taxes are being paid, right? QDMTT, IIR, and then lastly, UTPR. Thank you. Okay. So I think when we talk about the global minimum tax, it's always good to have an overview of what's happening, at least in Asia, APAC, in terms of implementation of GMT. Let's look at Australia. So Australia is one of the first jurisdictions where they are very serious about the global minimum tax. So PADMT IR is effective 1st Jan 2024, and the underpayment tax rule is 1st Jan 2025. Hong Kong, Singapore is similar. So 1st Jan, Hong Kong, Singapore, Malaysia as well is similar. The difference is that Malaysia is unclear of the underpayment tax rules, so that's still to be considered. South Korea, they do not have any QDMTT in place yet, but the income inclusion rule has been effective 1st Jan 2024, and then we have UTPR in 2025. And let's look at the next slide. Would be Japan. yeah, Japan is having a stance of not having a QDMTT and UTPR, but having the IRR in place, which is effective 1st April 2024. Thailand, similar to Singapore and Hong Kong, 1st Jan 2025 for all. New Zealand has recently, June 24, enacted the law whereby that IRR and UTPR effective 1st Jan 2025. They do not have QDMTT, but they have domestic IIR, right? Domestic IRR that is solely for New Zealand headquarters, which is effective 1st Jan 2026. Indonesia still keeping the stance of unclear, and Vietnam we have 1st Jan 2024 for QDMTT and IIR, and UTPR still underway, but unsure of the effective rate. And yeah, and we are looking at Asia, and I'm sure a lot of people are aware and have questions in relation to the bigger economy, how they are considering GMT. But I guess that is yet for us to see how it pans out, like US or China, sort of things. So yeah, so that's implementation in Asia.
Yeah, I think you're bringing a good point on big economies because I think India and China are still silent on it.
Mm.
So if we look at and go in a bit more detail, maybe just on the three major countries that we're working in, and look at Australia, look at Singapore and Malaysia. So if we look at Australia, and as HC has mentioned, Australia has got some guidance out there. Now, it was actually passed as part of our budget in Australia. The Treasurer announces the budget usually in May each year. So in the 2023-24 budget, the Australian government said that they would implement the OECD global anti-base erosion, so the GLOBE model rules, known as the global minimum tax, and the domestic minimum tax. So the 15% global minimum tax and the 15% domestic minimum tax will apply to the large multinationals with global annual global revenue of 750 million, so approximately 1.2 billion Australian dollars. Now, it is important to note there is a lot, you're probably getting 101 emails on it, you're getting emails from us, you're getting webinars, and all of the above. But the bill was actually introduced into Parliament on 4th of July 2024, but it is not yet law at this point. So it is in Parliament, but it's not yet law. And the in-scope multinationals will need to basically, they're going to have to provide information to adhere to the reporting obligations under the global minimum tax and the domestic minimum tax. So we're going to have lodgement forms, the Globe Information Return, we're going to have foreign lodgement notification, the Australian IAR and the UTPR. These acronyms are getting, as they keep going through these different pillars, we're going to end up with a lot of these acronyms: tax return, and then the domestic minimum tax return. Now, on the actual dates, if we're looking at the timing and the start dates for it, so just the start dates for the 15% global minimum tax for large multinational enterprises will occur over 2 years. So the income inclusion rule, as HC was just mentioning, so that was going to apply to years starting on or after 1st of January 2024. And as I said, it's not yet law, but it is actually, it's not yet law, but we're already saying it's going to start from 1st of January 2024. And the under-tax profit rule to apply from years starting on or after 1st of January 2025. The 15% domestic minimum tax is going to apply to years starting on or after 1st of January 2024. So the GIR and the FLN, they're going to be due 18 months after the end of the first fiscal year and 15 months after the end of subsequent years after that as well. Then we're going to have the UTR and the DMTR. That's going to be due 18 months after the end of the fiscal year. So I think it's going to be important. There's a lot of there's going to be probably a lot of confusion around the timing. So I think once we get some clarity, and I think I'd be putting those dates in the calendar, so to speak, to make sure you get those right. Now I'll pass you on to Adriana to go through some of the Singapore side of things.
Yes, so Singapore is 1 year behind Australia, Shannon. So you guys are always first tax,
They did,
first tax
right?
in the rank.
Yeah.
You did the same with CBCR, with Japan, but Singapore has decided to be 1st of Jan 2025. We have already the draft legislation that has been issued for consultation, but I think it's clear in Singapore that once you have a draft legislation for consultation, it's just gonna pass. Unless something, never say never, but most likely it is going to happen. Um, the first implementation is going to be on QDMTT, which is the qualified domestic minimum tax, and the IIR, which is the income inclusion rule that will allow the head offices to collect the top-up tax. I mentioned earlier about the importance of the international shipping exclusion, mainly because in Singapore being a shipping hub, it is an important exclusion for us to keep in mind. So in other words, international shipping income is not within the scope of GLOBE. Um, we will have very similar framework like Australia in the sense that you will have a GLOBE information return that in the first year is going to be within 18 months and in the following years within 15 months of the end of the fiscal year. So in other words, the first year, everyone is going to have a little bit more time to get ready, similar to Australia. And the top-up tax, meaning the payment, has to happen 1 month after presenting the income tax return. A bit different to the CBCR implementation, we're going to have to notify IRS on lodgement of similar returns in any other country. So I think one thing to keep in mind here is that even for Australia now that you guys started 1st of Jan 2024, is that the forms are one implementation consideration, but I think the tax provisions is what we have observed that the companies are being asked by the auditors. So for example, in Australia, most of the financial year ends is 30 of June 2024. So I think we had one case already that they have been asked, so what's the provision? So I think that's where companies are being forced to think about this from a provision point of view. So that's where I think different to Australia, we are only at this stage going to have two returns. One, which is the global information return, and two is the notification to IRS on whether there has been lodgement of a similar return in another country. That's as of today. You never know what could happen next day. Honcho in Malaysia.
Yes. For Malaysia, Malaysia's GMT guidelines is underway. To be released obviously before the implementation in 2025. We have obviously the Globe Information Return. So I guess we can treat the Globe Information Return as a CBC report type information, whereby the GIR is actually lodged by the ultimate parent entity, and this GIR is actually exchanged between jurisdictions. Then we have another return is called the top-up tax return, whereby each constituent entity in Malaysia will need to prepare and lodge accordingly. The due dates very similar. We have the transitional period of 18 months, and then 15 months after, but it can be 18 months after. That's yet to be seen. PTR 18 months after the end of the first fiscal year. So just to bring into context of effective tax rate, effective date. So the GMT for Malaysia and for those that starts 1st Jan 2025, right? So which means the December year and the first financial years to be in scope would be the 31st December 2025, right? The financial year, and which means the initial submission of the GIR and the TTR would be 18 months, and that date will be 30th of June 2027, right? So I think we need to make sure that this date for the in-scope groups needs to be put in somewhere to know that 30 June 2027 is needed. We need to lodge it by then, right? Actually, before that, we have really need to look at the GMT, but that's the deadline for the transition year, 30th of June 2027. All right. And for Malaysia, regardless, I think these returns are exclusive to income tax return. The submission deadline for Form C of the income tax returns remain the same, which is 31st of July, with a grace period of 1 month. So yeah, that's Malaysia.
All right, let's go for the last part of our webinar. First, let's look at the case study that hopefully puts all of this in perspective. So maybe we just look at, I'm putting the case study here because it's easier to understand the facts, even though the facts are in the other slide, but it's just for the purpose of making it a little bit easier. So we have company A, company B1, and company B2, and company C, and they are all members of the ABC group with past annual consolidated revenue as follow. Year one, euro 800 million, year two 730 million, year three 850 million, and year four 950 million. In year five, CA, B1 and B2 have an effective tax rate above 15 million. COC or company C has a global income of 10,000 euros and an adjusted corporate tax of 1,250 euros. So let's just go through the key questions that one could or will have to look into to understand global minimum tax in detail. So the first question is the group subject to globe rules?
Yeah. Just also to add on context, the examples that provided by Adriana, that obviously is just an example. We can talk about the other things as well, but including safe harbor. But okay, to answer the first question, yeah. So if we look at, as I mentioned earlier, we're looking at 2 out of 4 years, and based
Maybe
on
I go to the other slide so it's easier with the numbers. Okay.
if you look at it, 3 out of 4 years will be above 750 million. So that in itself would mean that they are in scope M&A group.
Okay. Then the second question is what is the effective tax rate in country C? And I guess the reason why we are saying country C is because this tax manager was super diligent and he already calculated globe for company A, for company B1, and for company B2. So he already went through the process of doing the adjusted corporate tax divided by globe income for each of the entities, because this is the thing here, that you have to do these computations for each constitute entity. So this tax manager was very proactive and he was already doing the calculations, and he already knows that company A, company B1, and company B2 has an ETR, effective tax rate, above 15%. So because of that, they don't come into consideration because, as we say earlier, if the effective tax rate is 15%, then okay, fine. You don't have to pay a top-up tax. So that's why company C is the one that comes into consideration here. So I don't know if I want to pick on you, Juan, to do the calculation of the effective tax rate here, even though we put small numbers for the purpose of the example, I guess.
Yeah. So if you look at it, the calculation would be adjusted corporate tax divided by the globe income. So it would be 1,250 divided by 10,000 would equates to 12.5%. So which is below the 15% global minimum tax.
So for those who are here, just just we divided 1,250 by 10,000, and that gives us 12.5. So then the question is, does company C has to do top-up tax?
Yes.
Yeah,
Since
right?
below 15%.
Exactly. So then the question, the following question is, what's the amount that company C has to pay?
So you'll be looking at the difference, the
Mhm.
times 10,000, which is 250 euro that is to be paid. So that's the amount of top-up taxes liable.
Yeah, which is basically 15% minus 12.5%, which is 2.5% times the globe income, which is 10,000. So that gives you 250, right? So that's the top-up tax. And then the fourth question, which is what everyone is like, okay, fine. So where do I pay my top-up tax?
So I guess let's look at the let's go back to what I said regarding an example. First, when you look at the safe harbor, if you say about a price, the de minimis test would have sort of apply here. Then yes, you apply a safe harbor, then your top tax will be 0. And under assumption that safe harbor is not available, so who is liable, right? First thing you need to look at is
Maybe I go back to the
yeah,
graph because it's easier.
that'll be easier. So if you look at you have jurisdiction country A, country B, country C. First thing you look at is where globe rules apply, right? So we'll be looking at the ultimate parent entity, right? So if you look at ultimate parent entity, which is company A, so under company A, country A has no globe rules implemented.
Mm-hmm.
So when there's no globe rules implemented, well, actually going back further is to look at whether there's any QD entity in place for BC. So if company C has no QD entity in place, then it has QD entity in place, then company C will be liable.
Mm-hmm.
So it stops there. Okay. So if QD entity is not in place, and then you have to fall back to your IIR. Now, if looking at IIR, as I mentioned earlier, that responsibility lies with the ultimate parent entity. And then when we look at the ultimate parent entity, the next thing you need to look at is whether the group rules apply. If no group rules has been implemented, then you have to fall back down to the intermediate parent entity, which in this case, company B1 and company B2, right? Both 50% owned. And then when you look at country B, okay, globe rules is implemented, right? So when globe rules is implemented, therein lies the obligation or the amount that is liable between B1 and B2. So
Mm-hmm.
as I mentioned earlier, the rule says that the company will be liable depending on the shareholding, the percentage of shareholding, right, of company C. So in this sense, we have 50% owned by each. So which means company B1 will be liable for 50% of that 250. B2 will be 50% of 250, which equates to 125 per entity,
Mm-hmm.
right? So that's when I was talking about the QDMTT at that time. When if QDMTT applies, then it will go straight to jurisdiction C. So
Exactly.
that's the final amount to be paid, and who's
Yeah. So this shows why everyone is trying to implement qualified domestic top-up tax and IRR. Because if you don't, then you lose the chance to get the top-up tax for your own country or for your subsidiaries. So you're right, like country C should have been the first one that receives the 250, but they're not receiving it because they're not implementing the global rules. So that forces countries with taxes below 15% to actually implement something. So they don't lose out on the tax. Um, so obviously these get more complex as you have more countries because you have to look at all of these rules, how do they play all in each country by country, right? Okay, so I think that's very, very helpful, Hon Chuan. The $1 million question that we get asked if only we had a penny. So if I'm gonna get global minimum tax, why should I care about transfer pricing? Or does global minimum tax just erase transfer pricing? So again, our dear ChatGPT, and we asked this question to ChatGPT, and actually ChatGPT, well, in this case, we do like ChatGPT because it says, yes, transfer pricing will still apply even if global minimum tax is implemented, while both transfer pricing and global minimum tax are mechanisms that address concerns related to international tax arrangements. They serve different purpose and operate on different principles. So I have to agree with ChatGPT on this one, that yes, they do serve different purposes. As of today, there hasn't been any inclination of any country to say that they are going to repeal the transfer pricing provisions just because of global minimum tax. And I think the reason for that is because, as we said, there is the groups within the scope as are the significant global groups. If you are not within the scope, you still need to look into your domestic tax regulations or your transfer pricing. So I think that's in essence my take as of now, that the two rules will just run concurrently, and then like when CBCR came into place. What is your take, Shannon and Hontran?
Yeah, and I think that that is going to be the way. And even when we saw it in Australia, when the thin capitalisation rules came in, we had the interchange between the thin cap rules and the transfer pricing. But, you know, we've just, I guess the three of us came back from an Asia Pacific transfer pricing conference. A number of tax authorities from around the region were also presenting and talking about this. I think there were also, some of them were rubbing their hands actually as well, getting a bit excited about some of the money that might be coming forward. But I think ultimately they're going to still have transfer pricing isn't going to be going anywhere. This is just one aspect that's just going to help where there may be, you know, lower tax being paid in certain jurisdictions.
Yeah, I mean, I agree with both of you. I mean, TP is going to run, it will be exclusive of GMT. If you look at the rules and the globe rules calculations, it actually complements TP, so to speak. So yeah, TP will be here to stay. And yeah, I actually like the ChatGPT.
Lucky for us.
Yes.
We've still got a
Yeah.
job. ChatGPT has not replaced it. And the global minimum tax has not replaced it as well.
Yeah, and I think the other thing is that from a risk point of view, the tax authorities still have the two rules. So they are, at the moment they implement QMTT, then they have the authority to enforce them both, GLOBE and TP as well.
Yeah.
All right.
But can we help you? I guess if if you do need assistance at all at any time with on the transfer pricing, maybe next slide as well. There we go. So I've jumped off. There we go. So yeah, if we got any questions as well, did we have? We had someone put their hand up. I didn't see any questions coming through.
Maybe it's a bit technical for people.
Yeah, it is. If you do have questions, do reach out to us. We can certainly help you around global transfer pricing documentation, around the master file, local documentation, you know, even going through, as we talked about today, and as Adriana pointed out, you know, don't forget the pillar one as well, looking at your amount A and amount B. I think, as Adriana said, amount B, it's kind of been a bit of this secret one that, or silent one that people haven't been paying attention as much. When you go through pillar two, if you need some help in going through those 5 steps that, as Adriana outlined and went through with those, or maybe it's even looking at the safe harbors that might be available to you. You will need to go through, whether it's for yourself or your client, you will need to go through, as Adriana's gone through, each of the different entities and actually break that down as you go through. But if you need some help, whether it be on global minimum tax and transfer pricing that as it links to it, we can also assist you around transfer pricing documentation, planning updates, looking at your contracts, and then benchmarking, whether it be global, regional, or local as well.
There is a question. Sorry, there is a question. So most low tax jurisdictions should adopt GLOBE rules then. Anyone want to have a go?
Yeah, I think the if you look at the mechanism, it is forcing low tax jurisdictions to actually to participate and to actually adopt these GLOBE rules, at least to implement the QDMTT in place to make sure that, you know, there's no tax leakages out to other authorities based on their domestic economic activities, right? So yeah.
I think in Asia, which we have Singapore and we have Hong Kong, which are the key, you know, maybe lower than others. I think they will implement it. Singapore already is in it, and I think Hong Kong also as well. Even UAE. is
This
also, yeah, is also going to.
Mhm.
All right. So as we say, we don't charge for our webinars, but we just appreciate likes and visits to our YouTube channel. So please like us, and we have some upcoming events as well. Just the two final ones that we have with ISCA. But Shannon, what's in the schedule for 2025?
Yeah, I think there will be quite a bit going on in transfer pricing in 2025. Obviously, we will be continuing with a lot of our webinars and in-person that we do have in Singapore as well as part of the relationship we have with ISCA. And we will do some webinars also on the operational kind of implementation side of this global minimum tax. I think that's going to be a hot topic, as we talked about earlier as well, your provisions. So, you know, don't go burying your head under the sand waiting for these rules to come into play. I think you're going to be getting people asking you to start calculating what those provisions might be. So we will look at in the new year. Obviously today we ended up being oversubscribed, but they can watch the recording afterwards. But I think what we'll do some webinars on that as well. And then on the Australian side, we will be actually having some in-person transfer pricing sessions in most of the major cities as well.
And I
So,
think also once we have the actual rules per country, we might do dedicated rules per country as well, because we don't have forms yet, but if we had it, we probably would have done that per country, but we don't have them yet. But I think once they come, we will probably do country by country
yeah.
rules as well. Someone is asking, do you provide amount B analysis? Yes, thank you for asking the question. We definitely provide amount B analysis, which is basically kind of a mini transfer pricing documentation analysis to understand if the company qualifies, and if it qualifies, what's the band in which it sits. So definitely we can help with that.
Great. Well, thank you very much for everyone in joining and staying on board for the whole time. I know it is quite a complex topic. I mean, I know no one's going to love transfer pricing as much as we probably do, but hopefully with our webinars, we try and put a bit of a practical spin on it. So, you know, hopefully that you will enjoy it a little bit and get a bit excited when we have to implement these areas. So we'll see you next webinar. Thanks very much for joining.
Thank you. Thank you, guys.
Bye.
Awesome.